Hey fellow dividend investors, welcome back to the channel. One of the advantages of dividend investing is familiarity. Over time, you get to know certain companies well. You understand their business models, you're comfortable with how they make money, and the dividends arrive with reassuring regularity. Sometimes, you're even a customer of the companies, and can keep a close eye on how good their businesses are doing. That familiarity can be a strength, but it can also quietly turn into complacency. Markets don't usually punish dividend stocks with sudden crashes. More often, they drift. Growth slows, costs creep up, and the sustainability of dividends quietly comes under strain. Other times, valuations stretch, and returns disappoint not because the business breaks, but because expectations were set too high for what the company can realistically deliver next. That's why, from time to time, it's worth slowing down and asking a different question. Not, is this a good company? But is this still a good place to put new money today? In this video, I want to walk through 3 dividend-paying companies that many investors view as dependable, even comfortable holdings. These are not broken businesses, and their dividends are not under immediate threat. But when you look more closely at recent operating trends, cost structures, and how the market is currently pricing them today, there are reasons to be more selective. This is not about fear or selling in a panic. It's about discipline. Understanding when a dividend stock is doing exactly what it should, and when it's quietly asking more from investors than it used to. Before we dive in, let me remind you that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. I own some of the shares discussed, but what works for me might not work for you. Alright, let's jump right in. Beverage. When cost relief isn't the same as earnings recovery. Beverage is often spoken about as a simple consumption story, but in reality it is a diversified regional consumer platform. Its business spans 4 main segments: spirits, beer, non-alcoholic beverages, and food. Of these, spirits remains the engine room. In FY 2025, spirits contributed just under half of group revenue, but more importantly, it generated the bulk of group profit. Beer is the second largest segment, while non-alcoholic beverages provide diversification but still operate in a highly competitive, margin-sensitive space. Geographically, Thailand remains the core market, with Vietnam positioned as the long-term beer growth driver. That combination has historically allowed investors to look past short-term volatility and focus on structural consumption growth. But FY 2025 was a reminder that even dominant consumer franchises are not immune to cycles. For the financial year ended September 2025, Thai Beverage reported revenue of about THB 333 billion, down roughly 2% year-on-year. Profit attributable to shareholders fell close to 7% to around THB 25 billion. These are not collapse-level numbers, but they signal something important. Demand softened enough that the group had to spend more just to hold ground. What's interesting is where the pressure came from. Raw material costs did ease, and cost of goods sold as a percentage of revenue actually improved. On the surface, that looks like the long-awaited margin tailwind investors were hoping for. But that relief was largely offset by higher operating expenses. Marketing, branding, and promotional activities stepped up meaningfully as Thai Beverage worked to defend volumes, particularly in its spirits segment. And that's where the deeper issue lies. Spirits volumes declined by low single digits in FY 2025. That matters because spirits is where Thai Beverage makes most of its money. When volumes soften in that segment, the company's response is rarely to pull back. Instead, it leans into brand investment and portfolio premiumization to protect long-term positioning. Strategically, that makes sense. Financially, it means higher costs today, with no guarantee that volume recovery follows quickly. Beer and non-alcoholic beverages offered pockets of resilience, especially in newer markets like Myanmar and Cambodia, but these segments are not yet large enough to fully offset softness in spirits. So while headline margins may look stable, the underlying earnings engine is working harder for each baht of profit. From a dividend perspective, Thai Beverage maintained its full-year dividend at THB 0.62, with a payout ratio rising to just over 60%. That tells you management is committed to dividend stability. But it also tells you dividend growth is now more constrained by earnings momentum than before. The share price has reflected this push and pull. Valuations look inexpensive relative to history, but they are cheap because the market is waiting for proof that consumption can reaccelerate without permanently higher selling costs. My quick take on this? Beverage is still a high-quality consumer franchise with scale, brands, and regional reach, but the investment character has changed. This is no longer a simple input cost down, earnings up story. It's a business spending aggressively to defend demand in a softer environment, especially where it matters most. As a dividend investor, I'd be careful not to buy too early into a recovery narrative. The dividend is stable. But until spirits volumes stabilize without elevated marketing intensity, I'd rather watch than rush. Sheng Siong, a great business that's now priced for perfection. Sheng Siong is one of Singapore's best-run supermarket operators. Its stores are concentrated in heartland locations, its product mix focuses on daily necessities, and its operating model emphasizes efficiency, scale, and value pricing. Groceries account for the vast majority of revenue, which makes the business inherently defensive and resilient across economic cycles. Operationally, Sheng Siong continues to execute well. Revenue growth in recent quarters has been strong, supported by a combination of higher footfall, government support measures, and an expanding store network. In the first half of FY 2025, revenue rose by just over 7%, while profit growth lagged at around 3% despite an improvement in gross margins. That divergence is the key signal. As Sheng Siong adds stores, revenue scales quickly, but costs scale too. Selling and distribution expenses have risen faster than revenue, driven by higher staff counts, wage adjustments, utilities, and depreciation from new leases. Even in quarters where revenue growth exceeded 10%, operating expenses grew at a similar or faster pace. This doesn't mean Sheng Siong is mismanaging costs. It means supermarkets in Singapore are not businesses where operating leverage automatically kicks in. Labor is tight, compliance costs are real, and competition remains intense. Growth is achievable, but it is not frictionless. The market, however, has been extremely enthusiastic. Sheng Siong's share price is up more than 60% year-to-date, pushing the stock into valuation territory that assumes not just stability, but sustained outperformance. At current prices, the stock trades at a mid-20s earnings multiple, a significant premium not just to the market, but also to its own history. At that valuation, the question is no longer whether Sheng Siong is a good business. It is. The question is whether the business can continue to deliver upside surprises when expectations are already high. Any moderation in same-store sales growth, slower rollout of new outlets, or cost pressure that limits margin expansion would not threaten the business, but it could disappoint the stock. Dividend yields, meanwhile, have compressed as the share price rose. Investors are effectively paying more upfront for the same stability they could have bought cheaper in the past. And that's usually where long-term returns start to diverge from expectations. My quick take on this popular retail stock? Sheng Siong remains a quality defensive business, and it deserves to trade at a premium. But premiums can overshoot. At current valuations, the stock is priced for strong execution with little room for error. For existing shareholders, this is still a comfortable hold. For new investors, I'd be patient. I'd rather wait for a period where expectations cool and the price once again reflects what Sheng Siong does best: steady, reliable performance, not perfection. If you're finding this kind of analysis useful, I'd really appreciate a quick like on the video. It helps the channel more than you might think. And if you want deeper write-ups and my latest thoughts beyond YouTube, do check out my website at thedividenduncle.com, where I share full analyses and ongoing insights for dividend investors. Kimley, stable cash flows in a structurally tight margin business. Kimley operates one of the largest networks of traditional coffee shops in Singapore, alongside food courts, industrial canteens, and a food retail segment that includes local brands and halal-certified offerings. Its outlets are embedded in residential estates, serving everyday meals at accessible price points. This makes Kimley's revenue base defensive and relatively predictable. Financially, the company is solid. For FY 2025, Kimley reported revenue of about 322 million Singapore dollars, up less than 1% year-on-year. Net profit edged up to around 33 million Singapore dollars. The group generated strong operating cash flow and ended the year with more than 68 million Singapore dollars in cash. It paid a total dividend of 2 cents per share, translating to a payout ratio of nearly 75%. The issue is not balance sheet strength. The issue is growth, and where it's missing, and why. Over the past 3 years, Kimley's revenue has effectively plateaued. New coffee shops and food courts have helped offset closures and weaker contributions from existing stalls, but they haven't driven meaningful expansion. In FY 2025, the food retail division actually saw a decline in revenue, reflecting rationalization of underperforming outlets and ongoing competitive pressure. Cost management has improved compared to earlier years, with cost of sales edging down slightly and gross margins ticking up to just over 29%, but the bigger picture hasn't changed. Around 70% of revenue still goes toward cost of sales, and the remaining margin must absorb labor costs, utilities, rent, and maintenance. These are not temporary pressures. They are structural. Kimley is responding sensibly by acquiring properties to reduce lease risk, investing in central kitchens, and expanding selectively through partnerships. But these strategies also increase capital intensity and fixed costs. With a high payout ratio, the company has less flexibility to absorb shocks or fund aggressive reinvestment without trade-offs. The dividend looks attractive and sustainable in the near term, but long-term dividend growth is constrained unless margins expand or revenue growth re-accelerates, neither of which is easy in Singapore's mature F&B landscape. My take on this is that Kimley is a dependable income stock, not a growth story. It generates cash, pays generously, and operates in a defensive segment. But it also operates in a structurally tight margin environment where cost trend upward and pricing power is limited. For investors who want steady income, Kimley can still play a role. But I'd be careful about expecting more than that. At the right price, it's an income anchor. At the wrong price, it becomes a stock that looks safe but quietly underdelivers. The Dividend Uncle's take. Across all 3 companies we've just discussed, the common theme isn't weakness, it's sensitivity. Sensitivity to costs, to expectations, and to how much growth is already assumed in the share price. In one case, the business is spending more just to protect demand. In another, the company is executing well, but the market is pricing it as if execution will remain flawless. And in the third, steady cash flows are doing a lot of work to support dividends in a structurally tight margin environment. None of these automatically make them bad investments, but they do change the risk-reward balance, especially for dividend investors who care about consistency, downside protection, and long-term compounding. Sometimes, the most sensible move is not to buy or sell, but to pause, to wait for expectations to cool, to let prices and fundamentals realign, and to remember that in dividend investing, patience is not inaction, it's part of the strategy. If you found this kind of deeper, numbers-driven analysis useful, do give the video a like. And if you know others who are building an income portfolio and want thoughtful, no-noise perspectives, feel free to point them to my website at thedividenduncle.com, where I share the full write-ups and ongoing insights. Let me know in the comments which dividend stocks you've started to look at more carefully lately. Until next time, happy investing!